Most Russian fuel exports from the Baltic and Black Sea regions are currently priced above a price cap established by a G7-led coalition in February. The coalition aimed to restrict Moscow's revenues following its Ukraine invasion, as shown by data from Argus Media, a price reporting agency. This surge in Russian fuel prices coincides with a global trend of rising fuel prices from other sources due to high demand and low inventory levels. The G7 nations, the European Union, and Australia implemented price caps for Russian diesel and other fuels to maintain market supply while curbing Moscow's earnings, following an EU ban on these imports that started on February 5. The EU ban prohibits EU vessels from transporting Russian-origin fuel above the price cap set by the coalition. The coalition stipulated a $100 per barrel price cap for premium trading products like diesel, while setting a $45 per barrel cap for discount trading products like fuel oil and naphtha. According to Argus data, prices for Russian-origin diesel, gas oil, naphtha, and fuel oil in the Black Sea and Baltic regions have surpassed the set price caps in recent weeks. However, Russian-origin gasoline continues to be priced below the $100 per barrel cap. A senior U.S. Treasury official stated that the price cap has effectively constrained Moscow's revenues and stabilized energy markets, despite recent price increases. Acting Assistant Secretary for Economic Policy Eric Van Nostrand indicated that the cap continues to limit Russian revenues and empowers non-coalition buyers to negotiate prices. Additionally, Russia's Urals crude oil has also traded above the coalition-imposed price cap of $60 per barrel. The Biden administration plans to intensify communication with Western trading houses, insurers, and tanker owners, reminding them to adhere to the price cap. However, this approach is expected to be subtle to avoid significant disruptions to energy markets. The EU's ban on Russian oil imports led Moscow to redirect its oil product exports to new buyers in West Africa, Latin America, and the Middle East Gulf. This shift has prolonged journey times for fuels like diesel and fuel oil, which were initially intended for European buyers. The data shows that this shift in pricing is primarily impacting fuels originating from the Baltic and Black Sea regions of Russia. Moscow's adaptation to the EU ban by rerouting its exports highlights the resilience and flexibility of the energy trade, even in the face of significant policy shifts. Remember to subscribe.